Welcome back to your Q2 2026 macro briefing. We are doing a deep dive today into the GBP USD campaign. And really, the mission here is to look way past that superficial illusion of interest rate parity to uncover the true incentives and the structural imbalances that are dictating global capital allocation right now.
Yeah, that illusion is exactly where so many get trapped. You look at the Bank of England and the Federal Reserve, and on paper, their headline rates are, well, they're sitting in the exact same neighborhood.
Right, like 5% is 5%. That's
Exactly.
not.
But if you are an institution allocating billions in capital, you aren't just looking at the sticker price, you're pricing in the machinery under the hood. A 5% yield from a stalling economy is a trap compared to 5% from a fortress.
I always like to frame it like real estate. Getting a 5% return on some pristine commercial tower in Manhattan is, well, it's vastly different from getting 5% on a house with a totally crumbling foundation. It is all about the structural integrity behind it.
Spot on. The US dollar gives you what we call high-quality yield. Yeah. And that's not just some macro buzzword. It means the US has deep, extremely liquid capital markets that can absorb like a $10 billion flow on a random Tuesday without flinching.
Just totally unfazed by it.
Completely. It has unmatched institutional credibility. Global capital isn't just mindlessly chasing yield right now. It is aggressively allocating towards stability. The UK, conversely, they really struggle to attract consistent inflows because that economic base is just so fragile, investors see the cracks.
Yeah, and those cracks go straight up to the central bank level. Because the UK's foundation is weak, the Bank of England is heavily constrained, right? Like they can't sustain restrictive policy the way the Fed can.
They absolutely cannot. The Federal Reserve is operating from a position of relative economic strength. They can safely keep interest rates elevated because the U.S. consumer is largely shielded by 30-year fixed mortgages. So the Fed hits the brakes, and the car doesn't immediately flip over.
Oh, right, because the UK mortgage market is totally different. You have millions of homeowners on 2 to 5 year fixed rates that are constantly resetting to these higher numbers.
Exactly, yeah. The UK is hypersensitive to borrowing costs. If the Bank of England hold rates too high for too long, they essentially bankrupt their own consumer base.
Wow, that is a severe constraint.
It's a nightmare for them. They simply cannot sustain tight policy without triggering deeper economic strain.
But wait, let me push back on that logic for a second. If the underlying structure is that skewed and the UK is walking this tightrope, why do we still see the pound occasionally spike on data surprises, like last week with that inflation print?
That is a crucial question.
Yeah.
It really comes down to how markets trade in our current mixed risk regime. Right now, the global market is incredibly bipolar, bouncing constantly between relief rallies and sudden panic.
Okay, so where does the US dollar fit into that?
Well, the dollar thrives here because it's uniquely dual purpose. It is yield-bearing, but it's also highly defensive. It pays you to hold it, and it's the global panic room when things go wrong. Those GDP spikes you see, they are just short-term noise.
Just temporary risk-on sentiment, basically.
Yeah, precisely. Maybe some algorithmic trading desk buys on a slightly positive jobs report, but it does not represent a structural shift in capital incentives.
So for positioning and execution, if you were looking at the setup, what is the actual institutional playbook? Because chasing those random downward moves seems dangerous.
It is. The strategy is clear sell the rallies. You do not chase the market lower. When you see those temporary periods of GBP strength, you use that brief window as a tactical opportunity to re-enter the short GBP campaign.
You build the positioning gradually, right?
Right.
Anchored entirely to the macro drivers, not the daily price fluctuations.
All right, exactly. You have to ignore the daily noise.
So what breaks this thesis? Let's move into our strategic outlook. What matters next? What are the specific catalysts that would force a massive institutional trader to just abandon this strategy?
There are really three specific catalysts that would invalidate this whole thesis. First, a decisive pivot by the Fed toward really aggressive easing, which would wipe out the dollar's yield advantage.
Got it. And the second?
A sudden, massive surge in UK growth and capital inflows. If they prove they can actually handle high interest rates without buckling.
Okay, and the third one?
A prolonged, highly stable global boom. If geopolitical risks fade entirely, capital leaves the U.S. panic room and just floods into higher beta currencies.
The riskier assets that grow much faster in a roaring economy.
Exactly. But until we see one of those massive shifts that U.S. Fortress holds, and the U.K. keeps struggling with its resets.
Right, which leaves you with a much broader question to consider for your own positioning. If global capital is now permanently prioritizing the quality and liquidity of a yield over the nominal rate itself, What happens to the rest of the world's currencies if the U.S. simply refuses to surrender its structural monopoly on safety?